Hey, and welcome to another video here at Fiscal Voyage. I'm Felix, and we're going to talk about NVIDIA. NVIDIA was suggested by JS. Thank you, JS, for suggesting NVIDIA. You guys could leave a comment below suggesting another video, a company you would like me to analyze next. So with that, let's start. We're going to determine if NVIDIA is a buy, hold, or sell. In a 5-minute stock analysis coming right now. All right, let's start with the 5-minute stock analysis on NVIDIA Corporation. It could be found in the New York Stock Exchange as NVDA. Funny note, NVIDIA is actually for Latin, where they come up with a name for NVIDIA, which is envy. So they just took out the I and just called it NVIDIA. It's an interesting note there. But NVIDIA is a technology company incorporated in Delaware and based in Santa Carla, California. It designed graphics processing units, or GPUs, for the gaming and professional markets, as well as systems on chip units for the mobile computing and automotive market. It primarily GPU product line labeled GeForce is direct competition with Advanced Micro Devices, AMD, Radeon products. All right, let's look at the fundamentals. The company grew its revenue at 15.02% from 2010 to 2019. In that same time period, net income grew at a whopping 225%, which is unbelievable. Currently have an S&P credit rating of BBB plus, investment grade, and operating income grew basically the same rate as net income. Earnings per share that same time period from 2010 to 2019 as almost 60% compounded growth annually. However, the last 5 years, revenue grew at 23% and net income grew at 56%. So it's much lower than their 10-year compounded annually. And however, earnings per share grew at 55%. This, I think, could be the cause of the mining with Bitcoin. As more people wanting to mine, they started to buy graphics cards. Let's look at more fundamentals. For their 2019 earnings, which was fiscal year 2018, they reported on January 1st, 2019 for their earnings, came in at $6.63, net margin at 35%, return on equity at 50%, debt to cap very low, debt at 70%. However, currently they have a low dividend yield of 0.31%, which is extremely low. I like to see companies at least 2.5 or higher, 3.5 or higher. This is where I like to invest in companies. However, they have a great payout ratio at only 11%, and they've been growing dividends at a nice rate for the past 5 years with a growth rate of 15%, and been growing dividends for 7 years. Net margin is expanding versus their last year of 31% of fiscal year 2018. The most recent dividend increase was 6.7% last year in November, and they actually haven't increased their dividends this November, so it looks like they're freezing it. So we'll see if they announce an increase for next quarter announcement. Future outlook for 2019 fiscal year, which they report in January 2020, it's going to come in at $5.56, and 2020 is expected at $7.30. So earnings are growing. CFRA projects an earnings growth of 20%, and my dividend drill return model comes in at 11.6% projected return. However, they have a forward PE of 29.15 versus a 5-year average of 36. Currently is at 36 PE, so its current price is actually quite high, the PE. If we see here the fast graph, we see that the black line is the monthly closing price, the blue is the normal PE, and the orange is the earnings with a ratio of 41, so it's much higher. So if we look at the fair value price, CFRA at 129, Morningstar at 145, Simply Wadi at 140, fast graphs at 201, Yahoo 232, and my dividend discount analysis at 36. That's low because they don't actually pay a nice high dividend, so that's why that's at 36. But if we average out the 6, we get a fair price of 147. Currently, you can get the company at 212. So that means the company is overvalued by 30.5%. However, I recommend it as a hold instead of a sell. The reason why I have it as a hold is if you have shares already, just continue holding it, and I'm sure eventually you're going to make money because of the growth. But I wouldn't buy it at this time. I would like it with a PE of around 25, between 20 and 25. I think I would consider it as a buy. I love NVIDIA products. That's my go-to product for a graphics card if I'm ever looking for a graphics card, or the graphics card is what I recommend for people, is NVIDIA graphics card. I like the fact that they're growing dividends. However, they did freeze it for November, but I don't like the dividend yield at current price. I think this company would be profitable for a very long time because GPU process is much, much better than CPU. But at this price, I'm not buying. I would like to see it much lower, between 20 and 25 PE. So with that, I recommend it as a hold. And if you have a company that you would like to see next, please leave a comment and let me know. Thank you for watching, and if you find this video informative, please hit the like button and subscribe to my channel for more videos like this. And I have my portfolio in the description link, and don't forget to look at my website, fiscalvoice.com. Have a great one, guys.